Moving average convergence/divergence, MACD, or MACD, is a trend-following momentum indicator that shows the relationship between two exponential moving averages, EMAs, of a security's price. The MACD line is calculated by subtracting the 26-period EMA from the 12-period EMA. The result of that calculation is the MACD line. A 9-day EMA of the MACD line is called the signal line, which is then plotted on top of the MACD line, which can function as a trigger for buy or sell signals. Traders may buy the security when the MACD line crosses above the signal line and sell or short the security when the MACD line crosses below the signal line. MACD indicators can be interpreted in several ways, but the more common methods are crossovers, divergences, and rapid rises/falls. Description: the moving average convergence/divergence indicator is a momentum oscillator primarily used to trade trends. Although it is an oscillator, it is not typically used to identify overbought or oversold conditions. It appears on the chart as two lines which oscillate without boundaries. The crossover of the two lines give trading signals similar to a two-moving average system. Developed by Gerald Oppel in the late 70s, the moving average convergence/divergence oscillator, MACD, is one of the simplest and most effective momentum indicators available. The MACD turns two trend-following indicators, moving averages, into a momentum oscillator by subtracting the longer moving average from the shorter one. As a result, the MACD offers the best of both worlds, trend following and momentum. The MACD fluctuates above and below the zero line as the moving averages converge, cross and diverge. Traders can look for signal line crossovers, centerline crossovers and divergences to generate signals. Because the MACD is unbounded, it is not particularly useful for identifying overbought and oversold levels. Note: MACD can be pronounced as either MACD or MACD. Here is an example chart with the MACD indicator in the lower panel. With the MACD chart, you will usually see three numbers that are used for its settings. The first is the number of periods that are used to calculate the faster moving average. The second is the number of periods that are used in the slower moving average. And the third is the number of bars that are used to calculate the moving average of the difference between the faster and slower moving averages. For example, if you were to see 12, 26, 9 as the MACD parameters, which is usually the default setting for most charting software, this is how you would interpret it. The 12 represents a moving average of the previous 12 bars. The 26 represents a moving average of the previous 26 bars. The 9 represents a moving average of the difference between the two moving averages above. There is a common misconception when it comes to the lines of the MACD. There are two lines: the MACD line, the signal line. The two lines that are drawn are not moving averages of the price. The MACD line is the difference, or distance, between two moving averages. These two moving averages are usually exponential moving averages, EMAs. When looking at the indicator, the MACD line is considered the faster moving average. In our example above, the MACD line is the difference between the 12 and 26 period moving averages. The signal line is the moving average of the MACD line. When looking at the indicator, the signal line is considered the slower moving average. The slower moving average plots the average of the previous MACD line. Once again, from our example above, this would be a 9-period moving average. Most charts use a 9-period exponential moving average, EMA, by default. This means that we are taking the average of the last 9 periods of the faster MACD line and plotting it as our slower moving average. The purpose of the signal line is to smooth out the sensitivity of the MACD line. The histogram simply plots the difference between the MACD line and signal line. It is a graphical representation of the distance between the two lines. It may sometimes give you an early sign that a crossover is about to happen. If you look at our original chart, you can see that, as the two moving averages, MACD line and signal line, separate, the histogram gets bigger. This is called a MACD divergence because the faster moving average, MACD line, is diverging or